China is in hatred. India is in hatred. Russia is in hatred that they didn't get an entrance to this G7 summit that took place last weekend. Yes, G7 summit puts in favor of those democratic countries and subjecting to ostracism the others. We may say it's right for those democrats that are at the democratic side of the fence, but there is rising criticism from other global powerhouses that decisions made at the summit disproportionately favor the interests of these nations that are included, potentially at the expense of developing countries or marginalized populations. And everyone wants its chunk of its global power. Thus, the fragmentation of the world just strengthening and how it may affect stock market performance. About this and other related topics, stocks, commodities and cryptos will be debating today, and you will know everything how to prepare to the upcoming market session just within a half an hour. So I'm very glad you decided to pop in. For the first block, there is a economy view. And as I have mentioned, that's the first block to just scroll through. So the countries of G7 really agree with each other that we are right now welcoming the post-China reality. Leaders from the group of 7 countries gathered in Hiroshima, and they said that they will implement an anti-economic coercion mechanism, drawing a Chinese rebuke. G7 nations face right now a long road ahead in winning over global swing nations being courted by China and Russia. So anyway, G7 wants to have a constructive and stable ties with Beijing, even as though they push ahead with steps to reduce dependence from it. Doesn't it sound like a sarcastic type of content? However, when you're looking for the constructive ties, the bone of contention is still remaining. Is this cheap war between the United States and China, and this is the one thing that may give the dominant power over the next decade over another country. So when this cheap war will be prominently winning by US, it will definitely lay the cards for the next time to come. Otherwise, there will be maybe China. Both countries want to reduce dependence on each other, and that will be the decade of possible pulling a tug war. Another very hotly debated topic was the regulation in generative AI, with concerns raised about the potential for disruption, disinformation, and medical errors. So Mr. Sunak said that they, as a UK, emphasizing managing AI risks and involving lower income nations in regulatory discussions. So can this G7 countries cause a breakdown for the markets? You have to study price action. You have many indexes already open, but right here on Monday, you may just look into US 100 and Nikkei, and you don't find anything ominous about them right now. Anyway, we're still right before the US market opened, and that will tell us more. What will be the reaction to latest data. But right now, there are not very signs of remarkable sell being noted. So we need to have reminded the conditions being set during the meeting may have its faceted repercussions upon the way on US and China ties, and also G7's attitude to Russia and its allies that we may observe in the weeks or months to come. That's the question. We are just wondering why the oil has dropping, why it's supposed to get rise in 2023 after this China Open. So the trading positions right now are also favoring the drops, but just have a look into the core of the problem. So we have been betting for expectation the Federal Reserve rate hikes will eventually provoke a contraction, but it didn't really materialize. We also have been betting for China. China has been less than booming rebound from its COVID-19 restrictions, and it also something that didn't come into fruition. So the gloom over the oil market this year has come from multiple directions, but right now it looks like this recession is also not that worrisome that we may have expected at first. So when looking at the price action, if we just jump to trading view, that's the kind of a representation of how the WTI performs right now on a weekly basis. We are performing still within this bearish type of a momentum, whereas during monthly one we can find that there are many buyers inside of the territory of 60, 64 and 70. So it means that the possible rebound might be imminent. Also, if we try to assess, that might be even very difficult at first, that when this pivot may take place, we may just wonder of what may happen to the economy. Within next months, we are expecting a possible recession. That's the Fed's stance, that it's not maybe the base case, but it may take around few months to develop it. Maybe that will be in a fourth quarter of 2023. Maybe it won't be that very fierce, but it may also lower down the sentiment across the markets. So right now WTI should really remain plateau, but if we just get back to our presentation, we'll find out that bearish sentiment in oil swells non-commercial net longs in major oil contracts at lowest in over a decade. And right now, this bearish positioning is just since last, and self-respecting hedge funds shouldn't set it up at the latest moment, and this pivot to the upside due to that much hedge fund positioning against oil is kind of a tidbit for many market makers that would like to possibly squeeze the price and maybe get some chunk of a profit for them. So I would say that right now anchoring mechanism may become a trap for many market participants that are betting that what has happened in the past may happen next. That's why I just appealing for a caution. All right, so right now market outlook and what we have right here. Maybe let's jump to much more of a data out of the markets. So SPY is the major index that given the pace. Oh, that's beautiful out of the monthly chart. Just look at this. This type of a consolidation or rather congestion area should give a real ramp ramp to push the SPY higher. It's very nice defense, and it brings us a much of liquidity, even though we just jump lower. The defendants that may come out of this area within a 340s and 400s is maybe absolutely astonishing. That's why I do bet that SPY right now is kind of a symbolizing that there won't be a recession within next months, at least, not that that fears as many have wagered. So right now, on a monthly basis, yes, SPY after this pin bar looks very strong. So we are trying to break out of this consolidation, and this big tech giving us another chance to see overbought conditions in 2023. So macro trends like low growth backdrop and lower yields support a recovery in these high growth companies. So expectations that the Fed may start cutting interest rates as soon as July to stoke economic growth have been also a key driver of big tech's rally. So those are the key themes that's right now pushing us to the north direction. All right, so we are right now heading back to the presentation. So fear was like a red rag to the bulls. Recently, we've seen that US 100 has broken out, and it brought much of a better sentiment. Right now, if we just look through the market sentiment on CNN, you will find it had crossed 65%. So we are in a top 1/3 of a sentiment, and it gives us a chance to just study what happened lately. So recently we said that sentiment among fund managers took a turn for the worse in the first half of May. And even though the price action of many indexes has been indicating that we are right over this bearish territory, with Nasdaq at least been sent to over 20% from the bottom, those hedge funds haven't, and fund managers haven't really listened to the market, but just been set in the side of this anchoring a mode of still awaiting for the recession. And they were terribly wrong. After a latest breakout of SPY and US 100 right now, we are undoubtedly finding that there is more power at the bull side rather than the bears, and betting against it will be strictly senseless. So right now, as we can find that this survey has appointed that when those low levels of positivity is on the market, and where we are in the flight to safety mode, an allocation to eventually more risky asset should eventually take place if the foundations of a economy are still resilient. So that's why we are right now having that squeeze to the upside. Also, we have noticed that many of investors have believed really into this proverb that sell in May and go away. But if we just study once again what was the performance during that month of May, typically during latest 40 to 50 years, we may find that the first half of May was kind of a troublesome, but the second one was absolutely better, and that's why you may sell at the beginning of May, as it was kind of a plateau back then in 2023, but then return in the second half of May, and that's what has materialized this way as well. So European investors also just heard the voices that you better sell in May and go away, and they have just been in a mistake. So many of you are not questioning the validity of such loud proverbs, but your portfolio, your wallet may eventually suffer from it. That's why you need to be rationalized. You need to be rational. And if we just study the best periods of highest returns, you may find that that mainly added the periods of time where this volume evaporates, and right after selling those stocks, all the books literally cleared out. And right now, the main catalyst is what we get the sense whether there will be a real effort to avert that debt ceiling catastrophe with June 1st fast approaching. And if it eventually been pushed, this debt ceiling being pushed higher, at first we'll have a optimism on the market, even turning into euphoria, and right after maybe sign on the news event, but it's still a few days ahead. So right now I'm just appealing for rationality. Living proof, also another one about the proverb S&P 500 returns after death cross on S&P 500 equal weight index. So this term of a death cross has been symbolizing the situation where the stocks are slipping below its 200. So when the 50-day moving average slips below its 200-day moving average, and that normally giving us a remark that we may get fearful. But as you do know probably that there are many algorithms that are trying to bet on the type of a return, and eventually they're betting the other side. That's why many of the retail that are unaware of that the media are trying to manipulate you by saying that loud words is just becoming a tidbit for those algorithms that are really emotionless and playing as they have been programmed in order to fool the greatest amount of market participants in the shortest amount of time. So when you have a concentration issue where the bulk of returns are in mega caps versus the average stock, taking into consideration this equal weight versus cap weighted ratio drops, we may find that right now it may be even more positive for stocks than becoming necessarily a bearish sign. So that's why we don't only have this type of a manipulation type of a event been talked over, but also the foundation that right now are playing out that are favoring the just few mega cap stocks over other that are less indulged into this AI narration right now. So right now we are just jumping into omnibus future. That's what I call by studying these mythic probabilities of hikes this year. So a market is betting with a high certainty that the interest rate cuts will take place on November this year, but Federal Reserve doesn't really admit it. So U.S. recession, what JP Morgan says, is a virtual certainty, but as you don't know, whenever such large players alongside the market, the majority of the market is betting for one reality that's more likely to not fulfill really. So this very high one-sided positioning often brings the many market makers that don't want to really, I would say, agree with the type of, or rather taking another side of a trade, and this would brings the situation where this balance between bulls and bears is appearing, and when we just bring a conclusion out of the study of markets, that the market is going the path of the least resistance. The least resistance is where those this balance is linked toward, this balance between demand and supply is linked toward. And when there is more bulls, usually we go into the bear territory, and otherwise, and in reverse. So that's why I do bet that these market makers, even this time, will obtain us with this additional volatility ignition that may cause some short squeezes. So we, on the other hand, just seen that positivity have recently been observed also on this 10-year Treasury note yields. So if we just take a look, there is if we just take a look for TNX, we find that it's right now breaking out of the consolidation phase, and the real point will be to get involved when you see clear evidence of inflation turning in those markets, which may not come until a bit later in the summer. Right now, we are still in the phase that these TNXs are rising, and it means that yes, we do bet that there is a high certainty of recession. That's what TNX is saying. And who would you better trust, those bondholders such as China or Japan and other nations, or rather market participants aside of central banks that are also a large part of a bondholders? So I guess that bigger player has a higher chance of being right, and that's why we shouldn't also bet against it. Right now, let's jump to crypto outlook, and that's what the correlation been also been found recently. So small correlation of Bitcoin to Nasdaq bringing us to a conclusion that Bitcoin and equities may have a large divergence both together with this large cap mega tech sector. So Bitcoin is not considered as being a very important feature of artificial intelligence revolution by now, at least. I do expect that it may play first fiddle when this Internet of Things, this global network of Internet of Things will eventually become our reality, but it's still the reality that we need to really live up to, and it may take over a decade in order to find its place right among much a bigger chunk of households. So right now Bitcoin is lagging behind, and it just awaiting its another narration spark. Maybe it will be the alternative to CBDC or any other related with technological issues. Maybe even it may spark due to this latest NFTs mania of ordinals that we've been lately been talking about, but hopefully this time without the type of congestion within the network that really paralyzed the structure once again. All right, so what about the market movers? Right now, let's jump to let's remain consumer confidence hovering out of the euro area. Right now is showing that we are approaching this minus 17 level, so it's getting better, but still still we are far from the situation where we may say that the worst is over. We are still in this very difficult reality where consumer confidence is still betting for the difficult elements to run businesses, and also worrying about the retailers are worrying about the financial situation by large. So economic situation within those countries are right now showing that that there might be the turmoil being prolonged in time. Right now, let's find out what about the economic calendar. So we have on Monday Fed Bostic speech. Maybe I will refresh it just once again. So Fed Bullard speech, Bostic daily. So we have many stances out of the Fed's members. On Tuesday, we don't have much of a data, but on Wednesday we have inflation rate out of Great Britain and FOMC minutes of US that may spark volatility. The Wednesday is the great time where normally greatest volatility take its place. GfK consumer confidence on Thursday out of Germany, and we are wrapping up the week with core PCI PC price index alongside durable goods orders out of US. So it's not very red letter week, but it's definitely some events that may spark a volatility and will be worthwhile to watch at in terms of analyzing the behavior. So what to watch out on in terms of earnings? We have a Zoom lows this week with Palo Alto, and on Wednesday Nvidia and Snowflake that are very loud names, and all of the world will watch and wait for Nvidia right after an astonishing first half of this year that it really beaten much of the stocks out of the SPY. Thursday, Costco. So that's very loud as well. And on Friday we have big lots and not. So we are strictly right now watching Zoom and Lois, as Zoom is Zoom Video is the third largest stock that ARK's portfolio ETF is consisted on. And as we do know, its results may also tell us what's about this reality, post-pandemic reality on the platform that connects people via video, phone, chat, and content sharing, and some platform that may be integrated across a broad range of devices. But right now, I don't expect the fireworks, right? So that reality already has terminated, and right now Zoom will try to survive rather than the thrive. In terms of lows, so it's more about the housing type of stuff, and we'll also look for the revenue growth right here. So unlike the Zoom Video that earnings are about to lower right now, low is expected to get better after this very nice second quarter rebound on the housing market. So well, low is skyrocket. You may point out on a chat going live in order to just share your point of view. All right, so we are right now jumping to trade idea in order to wrap up our today's session. So I have for you some few cents about WTI. So on a weekly we are still trying to rebound out of this 64. Sorry, I didn't switch the windows. WTI is trying to rebound out of this type of a double bottom formation, but it's not very really strong rebound. We are forming kind of a forming kind of a triangle that may bring some hopes for the further spike higher, especially with this liquidity being built underneath. But right now, before we'll just jump lower, jump higher, we need to really negate that latest very strong sell-off that took place back on Friday of 19th May. So right now I'm rather more bearish positioned due to this latest very strong sell-off, and I'm on WTI rather betting against such eventuality that we may really go through like a smooth sailing through this 73 area that recently been very strongly rejected out of the bears side. So we are right now hitting, if we just get for a fixed range, we are right now hitting another congestion zone that may reappear as the bearish type of a momentum. And if we just wanted to uncover what had the possible bearish type of a bet may look like, I will try to uncover this in such of a strategy. So right here I do find that this bet have a highest chance of being materialized. So we should push the WTI right now to levels of being limited by 72.36 and 72.91, and right after rejection we may get back lower to this 69.61. But you may await for confirmation with any type of bearish type of candlesticks being formed around here, 70 level indeed. So that's my view for WTI for this week, and this risk-reward ratio at 3.39 still looks very decent. So let me know in the comment section below or write in the chat what you think about that bet. I'm still finding that WTI will be more likely predestined to move lower until it eventually move higher. For now, the recession bets are still strong, but WTI doesn't really collapse, and it's trial to move higher anyway. The price action tells us one thing: there is right now a ton of congestion right above the current price performance. That's why I'm by watching the type of a recent price action, I'm more bearishly positioned rather than into other direction. So in my view, and in this episode, that's it. Thank you very much for sticking around, and see you tomorrow as always, 8:45 AM East time.